Good morning, everyone, and welcome to Kennore's Build and Scale webinar series. This morning's webinar is Smart Tax Strategies. So first of all, I'll introduce Kennore. We're a firm of over 80 staff specialising in offering compliance and business support services, outsourced bookkeeping, payroll and management accounts to our clients. We're a multi-award winning online accountancy and company secretary firm supporting SMEs across Ireland, Northern Ireland and the UK. I'm joined this morning by Tom Francis, Head of Accounting at Kennore. Tom manages a large team of accountants and bookkeepers and supports our clients across a broad range of industries. He takes the view of your accountant should be a strategic partner and works closely with our large and scaling businesses. It's important to note that this webinar is for general information purposes only. For specific advice, we always recommend reaching out directly to an expert, and we'll share our contact details at the end of the webinar as well. That being said, Tom and I are happy to take your questions and we'd love to see interaction from all of our participants today. So please use the chat or question and answer feature and I'll pose your questions to Tom. So just moving through what we'll cover today, we'll be talking about profit extraction, closed company surcharge and year-end planning, as well as dividends versus pension. So I'll hand over to you now, Tom, so that you can cover profit extraction and closed company surcharge.
Thanks, Christina, and good morning, everybody. Yeah, I think from the point of view of our approach this morning, we wanted to kind of look at, I suppose, the strategic part of running a business. The operational part, I suppose, in making the sales and making the profit is good, but being strategic in terms of how that profit is extracted is really important. We'll also look at planning around year end, and we talked a little about dividends and the closed company surcharge as well. So I suppose, my opinion, I suppose, if you take nothing else from today, it's my view that most business owners are taking money out of their company in a way that potentially costs them more tax than it should. And that's not usually because the options aren't there. It can be because the planning hasn't been fully thought through. You generally have three levers. You're looking at salary, you're looking at bonus, and you're looking at pension. And the key message is dividends are there as an option, but often they're more of the least favorable option, last resort, not so much a strategy in my view, because there's no corporation tax deduction with dividends. You can move quickly into the higher personal tax rates and you can lose some flexibility as well. So the question we're always asking is, have we fully used the salary? Have we fully used pension before we go to dividends? Because in most cases, the answer can be no. Now, if salary, bonus, pension aren't fully optimized, you're potentially leaving money on the table. Dividends have a role, don't get me wrong, but not the primary role. They should be in there maybe as a final step, not a starting point. So that becomes really important then, because when profits are left sitting in a company, things like this closed company surcharge comes in. And that's the piece I see catching people out a lot, actually. So with the closed company surcharge, it's effectively an extra tax that can apply in a closed company. Closed company is I suppose, you think of your typical SME, company controlled, managed by 5 or fewer people. So I said most owner-managed companies fall into that category. And in those cases, revenue can apply additional rules. But the crux of it, I suppose, in simple terms, is it's a second layer of tax, bringing your effective tax rate from 12.5% to 20%.
That's steep for businesses, isn't it, Tom? And that jump from 12.5% to 20%. And in your experience, there's a lot of ways to mitigate having to fall into that. I mean, the closed company surcharge will apply, but it's applied on profits of the business, right? So it's about being efficient with your tax and your planning and managing your profits effectively.
Indeed, and I suppose what I should preface this with is it mainly applies to professional service companies, investment/rental companies as well. It doesn't apply to companies across the board, but there's a lot of professional services companies out there, and there's a lot of those investment rental companies out there as well. So, like when we as you said yourself there, you know. Um, if in those situations those profits are left in the company without a plan, the tax base can increase quite significantly. If we look at professional service companies, you're looking at your solicitors, your accountants, consultants, engineers,
Okay.
architects. Like increasingly, we're seeing IT consultants come in there as well, advisory firms. So I suppose just it doesn't apply to everybody, but it applies to a lot, I would say.
And a lot of those consultancy companies, Tom, would typically work with a lot of then consultants as well, rather than putting people on payroll. But you mentioned something there about 5 employees. Does that apply where if it's a larger business providing IT consultancy, let's say, or providing solicitor or any of those professional services that you mentioned, does that exclude them from the closed company surcharge?
Well, it depends, and it's not 5 employees.
Oh, sorry.
It's five owners essentially. If it's owned by five or
Okay.
fewer, so your typical SME would be owned by five or fewer
Management.
people. So
Okay.
it's a maybe. It could do, like, I suppose if you go to scale, probably not. Like a lot of maybe the larger corporates wouldn't be necessarily closed companies, but you have a lot of SMEs are.
Okay.
Mm.
Ruben has just given feedback that he's struggling to follow and just would like to understand what the closed company surcharge is and where does that apply ever. So I know you've clarified some instances there, Tom, but it's an additional tax,
Yeah.
but applied to professional services companies.
That's it. Now, I'm glad that question was asked because it is a chunky piece to digest. So I suppose the close company surcharge, it's an extra tax effectively. They call it revenue call it a surcharge, but it's a tax surcharge, I suppose, effectively. So if you're operating in professional services, like even ourselves now, like we're potentially in that category. Um, so effectively, effective corporation tax rate goes from 12.5% to 20% there's if retained profits are not taken out of the business effectively through the usual sources, like you haven't taken it all out in salary, you haven't taken it all out in dividends, and effectively revenue's way of, I suppose, taxing those companies for sheltering profits within the business. Doesn't apply to every business on the planet, absolutely not. You're looking at your professional services, as I said, like, so, accountants, solicitors, IT, more and more, we're seeing that now as well. But equally then, if there's companies operating in the rental sector as well, there's a surcharge applies there if profits left sitting in there. So yeah, it's kind of across the board really, and I suppose this is more for awareness of it as opposed to anything else.
Course, yeah,
Mm.
appreciate that, Tom, and thank you for that clarification. Then moving on to what you've touched on there is the ways to get around,
Mm.
being strategic with your tax planning
Mm.
is looking at year-end planning and looking at the options of dividends versus pension in more detail.
Indeed. Now, Christina, I bumped over the part about working with the closed company surcharge, working around it. Will we do that now, or will we do it? Do you
Oh,
want to do
yeah,
that
you
later?
can do.
Yeah.
No, no,
Yeah.
yeah, you can do that now. Yes.
So, effectively, what we're seeing more and more as well, like with companies that are, in that territory of closed company surcharge area, if you have your structure set up in such a way that you can change the outcome, that works. So, um, what some of our clients do is they have the regular trading company, which potentially is liable to the surcharge. To get around the surcharge, you have to pay a dividend out to the shareholders. But as we said earlier, dividend isn't the primary strategy here. It's more last resort because of the high income tax rates, no tax deduction, etc. So it's not really the thing we want to do first. But if you're coming into close company surcharge territory, you have to do something. Now, what clients are doing then is they're setting up what they call a holding company. So you have your holding company on top, which owns the shares in the trading company. The trading company pays the dividend up to the holding company, but keeps it within the group structure, so the cash stays within the group. And revenue will allow the closed company surcharge to be mitigated if a dividend is paid. It's not great to pay a dividend out to the shareholder, because of the income tax rates. So paying a dividend up to the holding company often works. So holding company receives the dividend, and the trading company then and the holding company, there's a rule within revenue. If you make an election, like they call it a Section 434 election. Um, Basically, there's no effectively tax on those. So it is good. And just, I suppose, again, just for awareness. So if that's done, you keep the wealth within the group. There's no surcharges in the trading company, the holding company. And it does matter because without that type of structure, owners are often forced to take money out personally when they don't necessarily need it or want it, but just to avoid the surcharge. And that's probably the key takeaway is there's potentially other options out there, Christina.
Yeah, that's it. And it comes down to that strategic planning, doesn't it, Tom? And that's where talking with your accountant and getting that advice. Would you say that best practice is that clients sit down with their accountant, not just to talk through the numbers of last year and the historics, but actually to take that strategic time to get some support and say, how do I do this properly? What way can I set up myself for success where I can maximize on my take home rather than paying more tax?
Yeah, indeed. I think that's a fair point because time. One of the points we're going to make today is that timing's everything because
Mm,
where most of the damage happens is probably that lag between year end and when a set of accounts get done, which could be it could be a 14, 16 month period. Year end passes, accounts are prepared, and then it's too late to put money into a pension. It's too late to do the strategic stuff. So good tax planning is what you're alluding to, Christina. Really, I think has to happen before the year end, but should probably be on the table all the time effectively, not just kind of a once in a lifetime thing.
that's true.
So before year end, like almost want to estimate what the profits are going to be. You want to review what the salary is, review what pension capacity is there, and indeed look at the surcharge exposure as well. Don't wait for the accounts because it generally too late, and they can be difficult conversations. If we have to have them with a client, because if we had the conversation, 6 months earlier, there could have been a very different outcome.
Absolutely. Okay, that's really helpful. Dylan has asked, why is close company surcharge even a thing? Isn't that very aggressive towards startups? What about keeping money in the bank for growth? Taking it out all the time limits this.
Indeed, and Dylan is right. He's absolutely correct that it is very limiting and punitive.
Yeah.
And I suppose traditionally speaking, a lot of professional services business used to operate as sole trade partnerships, at which point all the profits are taxed. But then, more and more, what started happening was the limited company was set up really to protect the owners, I suppose, with the indemnity. But revenue then realised, we're not getting as much tax as we should be getting, so therefore we'll apply the higher tax rate, which will help that. But it is punitive, all right.
Absolutely, yes, yeah. And so hopefully the solution that Tom has discussed there, Dylan, is something that you could consider if you feel that it applies to you. It's really important to have that tax planning in place. Okay, so we'll move on to then, as you said, Tom, there, that year-end planning and being proactive rather than waiting until after the year end.
Yeah, indeed. So we touched on this a little bit already. So like as on the slide there, act before the year end, not afterwards. So don't let the year end pass. Before the year end, even just open the line with your accountant because you probably have a fairly good estimate of where the profit will be at. What the salary is, what the pension capacity is, and indeed, if there is other opportunities there, it's a good time to do it before the year end. Because if you look at pensions, for example, if you're going to if you're going to top up your pension before you have to do it before the year end to get the tax write off. The cash has to leave the bank in the year to get the tax write off. So it's really important. If you're going to take extra salary, again, you plan for it accordingly. But that can all be done kind of in reasonably good time. It doesn't need to be madly before the year end. It could be a month before the year end or 6 weeks before the year end. Just to quick look at the numbers, see where they're at. What I suppose ultimately most strategies are defined by what the end goal is. Like what looks good for the business owner at the end. Where do they want this to go to get to? Do they want to build up wealth in the company? Do they want to build up wealth personally? There's lots of different, I suppose approaches will be taken depending on what the end goal is. And the end goal is different for everybody, but it allows, I suppose, the strategic proactivity that's needed.
You're absolutely right, Tom, isn't it? It's about having that discussion with your accountant about what your end goal is for you individually and then working towards that. Yes, really, it comes down to that planning. And that's a really important point that you made there about the the money having to leave the bank before the year end,
Mm.
So I'm talking to business owners all the time and where they say, oh yeah, well, my year end, and then I'll talk to my accountant. Whereas you're flipping that completely and saying you should be talking to your accountant before your year end, making sure that you have everything boxed off rather than just talking to them when your accounts are due or when um there's something that you
Mm.
often say is that by the time you get to that, it's old news.
It's old news, and like most business owners are very much so in the current anyway. Like
Mm.
last year is forgotten about by the time the last year's accounts are done. But if like for example, like we would do a lot of regular bookkeeping for clients, management accounts for our clients, and that stimulates a different conversation then because there's reasonably up to date numbers, and if you're in that situation where you have reasonably up to date numbers, I think different conversations can happen, be that strategically or otherwise. But definitely, having the conversations at the right time is key.
Yeah, and you touched on the topic earlier on dividends versus pension. So in terms of pension, Tom, what like is that the most tax efficient way to get money out of the business?
I mean, I think I can never remember myself saying anything otherwise. Like pensions are, where the real opportunity sits. Like dividends are simple, but they're expensive. But with pensions, you get the corporation tax relief, no immediate personal tax, and obviously tax efficient growth within the fund as well. So for owner managed businesses, pensions are the most tax efficient extraction tool available at the moment. There's obviously limits when it comes to pensions. You can often contribute 100% to 150% of salary, sometimes more. Now, again, that there's work to be done to figure out what the max contributions allowable are because they're different for everybody, for every business, because you have to get formal funding calculations done. If you know the exact maximum contribution that can be made. But what I would say is, no matter what, they're so tax efficient. There's nothing that beats them. The challenge is you don't get that cash today. You might get it, in a number of years' time, but you are moving money from the company to your personal fund, and there's no tax applies. You get the full tax write-off.
Yeah, okay. Yeah, that's really hopefully helpful for all of our attendees where you may think that, okay, yes, grand, I have a pension in place, but it's about being strategic about that, getting the right advice, having it in as the maximum contribution. And then there's a lot of advice online, Tom, and a lot of noise around business owners should be pulling out dividends and that it's the most tax efficient way. But that's only really when the structure is right, as you said. So it's about looking
Yeah.
at that.
Like there can be situations where, it could work better, like particularly around non-resident businesses,
Right.
I've seen situations like that. But I suppose for the purpose of the conversation here, like we're looking at, I suppose I'm aiming at in my advice at, I suppose Irish resident
Absolutely.
companies, and all that. So in most of the cases, yeah, they're not tax efficient at all.
Yeah. Okay.
Mm.
Great. And I know that in terms of a couple of key takeaways, the elements that we were talking about was the window to
Mm.
act. And I know you've touched
Yeah.
on this a little, but I'm sure you want to go over this.
Yeah, for sure. So the slide here, I think, just reinforces the timing point really. So the window to act is, it's actually a little bit smaller than most people think. Having a simple checklist like knowing your year end date, not everybody knows their year end date, but just if you're not sure, check with your accountant, check with the CRO. It's all there. Review the mix, your extraction mix. So is it salary? Is it pension? Is it bonus? What is the mix? What is the end goal you have in mind? Check your pension position out, and then I suppose big one is knowing if the closed company surcharge was applied, because that will determine whether you're letting cash build up in the business, whether you have to make an alternative structural plan, whether it's having the holding company or whatever that might be. But if you get those right before the year end, I think potentially you're in a very strong position.
Yeah. Yeah, that's really helpful, Tom, in terms of all of those reminders of, to know if closed company rules apply. That's key, isn't
Mm.
it? To then know how to act. But even for businesses where that doesn't apply, it's so important to act before their year end, as you've touched on in all of the content today, to just make sure that you're doing all of that tax planning.
Exactly, yeah. So yeah, so even if you're not in that closed company territory, I suppose that's only just one angle of the whole planning piece anyway. It's probably the final part where you determine whether you need to pay something up or out or over or whatever it is. So it again, it just forms part of the bigger plan.
Yeah.
But yeah, so I think it's the big picture really, Christina.
Okay, thanks for that. Now we have some questions that have come through. So can our accountant help with addressing this? We don't have much awareness of this as an early stage service business. Can the holding company be outside of Ireland?
Typically, holding companies can be outside of Ireland. We have clients with holding companies all over. Now, what I would say is that the holding companies outside of Ireland just check the tax position on the holding company if it is in receipt of income from the Irish subsidiary and what the tax position is there. But certainly can be. You can have holding companies all over the world for sure.
Okay. Okay, great. Then a comment more than a question there. I feel this is discouraging us from keeping profits in the business to help us sustain and grow.
Hmm.
If we don't have much available capital, we don't want to lock everything in a pension. What is the option to keep profits tax efficiently but available to reinvest?
I mean, I think having the like if you are in that closed company surcharge territory, you can pay the tax. I suppose is the simplest one. And by the way, we have a lot of clients who just pay the tax. So they get 20% tax hit as opposed to 12.5. Um, the holding company is for me, has to be on the table because you're keeping the cash within the structure. It's not leaving. So if you have a holding company structure, you can move money from you could pay a dividend up to the holding company. But if the trading company needs it or wants it, it could move the money back. The money can always move up and down. There's no question there. So I would say that's not a problem. It can be worked around. Yeah.
Yeah.
Mm.
Thanks for that, Tom. Then Dylan has commented loan accounts to owners to mitigate the surcharge?
Mm.
Question mark.
No, this is kind of like what I'm reading by this is like could be like a director's loan, that kind of thing. Now, I've seen company owners make use of a director's loan strategically, all right, but that won't mitigate the surcharge in my experience anyway. That's generally just a balance sheet transaction, and it's loan in, loan out. One
Yeah.
point on those loans though, if let's say a director's loan, if you do have a director's loan, like I've seen some businesses, take a loan from the company on the 1st of January, um, year end is the 31 December. Make sure the loan is paid before the 31 December. So it's effectively an interest-free loan for that year. But definitely, there's different strategies there on the director's loan, I would say, more so than the surcharge.
Okay. Yeah.
Mm.
So a lot to cover there, absolutely, Tom. Thank you so much for all of your insight and support. I'd say the key takeaway from everyone for this is to check if the closed company surcharge applies to you, and know and talk to your accountant. Get that meeting in with them before your year end so that you have discussed your business in detail, discussed what your goal is, and really good habit would be, Tom, to do that regularly, to talk to your accountant, not just about the year end numbers, but actually talk about your forward planning.
I believe so. Like it's about it's and having alignment with that longer plan, whether as you say, whether
Yeah,
it's building wealth, whether it's involving family or that exit, what the plan is. Because again, everything can be strategized in that direction, whether structurally or otherwise. So definitely keep your accountant or your advisor in the mix in terms of what your plans are.
absolutely. Okay, we haven't gotten any other questions through now. So if there is anyone, we have another minute if you'd like to submit any questions that you have. But in the meantime, I'll just tell you that tomorrow we have our next stage in the Build and Scale series, which is the bookkeeping fixes every growing business needs. So if you haven't registered for that already, you can check it out on Kenora.com, and it'll be at 10:30, just for again 30 minutes, where we'll be covering a lot of um, the tools that you need for automating and digitizing and for moving your bookkeeping forward. So, Just checking, there's some other questions that have come through. Is there any restrictions on taking a bonus out from the company? Can you wait until year end and then take out a bonus if there's high profits?
No, it's a good question. There's no restriction. You can take the bonus anytime. Effectively, bonus is salary anyway. It's just
Mm,
timing. Like some business directors might not take a salary for 6 months of the year, for example, and take a lump at the end. Take a regular salary and take a lump bonus at the end. So there's no restrictions. No, that's just I suppose a decision the company makes. To do. So depending on the results, it can take a bonus. So whether the bonus is taken in month 12 or month 14 after the year end, that can be done as well. I suppose getting the tax write-off in the right period is the key, but there's ways around that as well. So I think that's a really good question, and thank you for asking that.
yeah, and I've just recalled that there was a couple of questions that had been submitted in advance as well, Tom. So there was, can I pay myself a once-off director salary before the end of the financial year, even if I've not been drawing a regular salary during the year?
Yeah, that's effectively what we covered there. So
Yeah.
yeah, yeah,
Yeah.
yeah.
Then on pension contribution, is it possible for the company to make a pension contribution on my behalf if I've not been paid any salary, or would I
No.
need to process at least some salary through payroll first?
I said no there very quickly because
Yeah.
the allowable pension is based on basically your pensionable salary. So if you have no salary, therefore there's no allowable deduction. So the salary needs to come first before the pension. You can't just do pension no salary effectively.
Yeah. And
Yeah.
then, Tom, I know something that you've covered in other webinars before is that owner managed businesses, particularly if they're a director and shareholder, um, they're they should be on the payroll essentially and processing a salary for themselves anyway.
Yeah, generally rule of thumb would be
Yeah.
that no matter where they're resident, yeah, they should be on Irish payroll and subject to Irish tax deductions. Yeah, yeah,
Right. Okay.
yeah.
Yeah. So then that's essentially, we were going on the assumption that you're Irish resident director, if you're working on the business, that you're processing a salary for yourself, and then the pension contribution becomes just that add-on for tax efficiency and for maximizing on getting money out of the business for yourself. Then one other question was just what's the best way to employ a student to help with admin, content, and operational work? Should this be treated as part-time employment or contractor work? So I suppose if we're taking that on the angle of for tax efficiency, Tom.
Yeah, for I suppose tax efficiency and then I suppose employment law as well. I suppose just bear in mind there's two angles. I think with both angles, yeah, you get tax write off, but I suppose just be careful if you're hiring somebody as a contractor when they work exclusively for you. And there's certain rules around whether someone fits into the employee versus contractor box, and that's something revenue are looking at the moment. You can potentially do both. It's always cheaper to have somebody as a contractor because they say there's no employer's PRSI, which makes it cheaper for the business. But I suppose you just want to make sure that you've ticked the boxes. If you're not sure, just check with your accountant or advisor, and they'll let you know pretty quickly which would be okay.
Yeah.
Mm.
And then just one last question from David, and I think you have covered this a little, but what is the difference between salary, lump sum, and bonus? Are there any different tax implications?
I suppose effectively it's all income tax, PAYE. So there's no difference. It's kind of just what you call it because one is salary is kind of like most people get a regular salary, whether it's monthly or whatever they weekly, but the bonus just comes at the end as a lump. So effectively they all get tax write-offs. And no, I mean it's just what you call them really. Bonuses for doing something, right? Have you met a target or whatever, as opposed to just your regular salary for turning up.
Yeah, but it's all
Mm.
taxable income, as you
Yeah,
said. And
exactly.
then one just last question's come in. Sorry, I know we've had a lot of questions, Tom, but thank you for your patience. Is there a limit to the amount of pension contribution as a ratio of salary, or is it just that there has to be some salary?
Well, that's a good question. What I touched on during the webinar this morning was like you can pay 100%, 150% of salary. The only way to know truly what the maximum number is, though, is to talk to your pension advisor because they'll be able to tell you what the number will be for the company pension fund. And I suppose a lot of it depends on what the salary is, what your retirement age will be. There's a couple of different factors, nonetheless, even though it's company. So there is a limit, but it's generous enough, I would say, at that rate.
Yeah. Okay,
Mm.
great. Thank you so much, Tom, for all of your patience in answering all of those questions. Thank you to our participants for engaging so much and asking us so many questions. I hope you found this webinar beneficial. John has commented that he found it very beneficial. So thank you so much, everyone. Have a great day. See you
Thank
tomorrow.
you all.